When it comes to the stock market, I have some bad news, but I also have some really good news and how it could impact your investments or your portfolio moving forward. The bad news, of course, is the recession is officially here, and no one has a crystal ball on when it will end. It could be a few months or it could go all the way into 2023. And the good news is there are still good stocks out there in the market right now that you can buy to help weather your portfolio against those economic downturns that we saw in 2008, 2020, and what we're experiencing right now within the market. So in today's video, I'm going to cover 5 separate individual stocks that historically have outperformed the market during those recession years or during those years where we have seen an economic downturn. So the first one in the list is Wal-Mart, or what my grandpappy used to call Wally World. In a world where Amazon typically seems to dominate all the retail news, Walmart has steadily become more diversified and has evolved with its business model, which at the same time has enabled them to ride out these major economic downturns back in 2008, 2020, and most likely what we're seeing right now. So giving you a brief snapshot of what Walmart stock is doing right now, they're currently trading at $122 per share roughly, and has posted a modest increase of around 7% each year the past 10 years. When you compare Walmart stock to the S&P 500 index, which they are part of, they have outperformed the market during those economic dips or drops each and every time. Now keep in mind, this is a company that continues to attract investors because of their dividend yield. And right now their dividend yield pays out around 1.82%, which equals to roughly 50 cents per share right now. Now, it's also important to note when we're talking about the dividends and the quality of dividend, they have increased their dividend or continue to pay out their dividends every year since 1974. And number 2 on the list is Lowe's Companies, or what used to be referred to as Lowe's Home Improvement Stores. Now, back in 2020, when COVID shut everything down for a couple of weeks and it seemed like everyone was staying at home, no one could have guessed the amount of success or the surge in sales Lowe's would have experienced back then. I mean, everyone that seemed to own a home or a rental property was taking that time to do renovations because the housing market was still doing very well, and everyone either wanted to do all those honey to-do lists and get those boxes checked or get their house ready to sell. So as a result of the surge in sales and this influx of customers, Lowe's beat the S&P 500 index by over 60% since 2020, and they beat the index by 35% back in 2008. Now, with the housing market still going relatively strong with no major dips, we've seen some areas where it's kind of settled down, but the reality is people are still fixing and selling homes like it's never been done before. Home projects are expected to increase by over 20% going through 2023. And right now, Lowe's is trading around $184 per share, and they've seen an impressive 560% gain the past 10 years, which is just incredible. And as with any good stock, they pay out a dividend yield of over 2%, which comes to roughly $1.05 per share. And number 3 on the list is Abbott Laboratories. Abbott is a diversified healthcare company, which, as you can imagine, has done very well since 2020. However, even before the whole COVID thing came about and all these medical companies had a huge increase in sales, they did very well for themselves. Abbott was having very good returns with slow and steady increases since the 1980s, with no major declines within any economic downturn. Currently, they are trading around $108 per share, and they have posted a steady and consistent increase of over 250% the past 10 years. Now, if you know anything about my investment styles on this channel, you do know I do love me some companies that pay out a nice, comfy, but safe dividend. And Abbott checks all those boxes when I'm looking at a company as far as their dividend yield and their dividend payout. And Abbott has a dividend yield of roughly 1.73%, which comes to roughly 47 cents per share. So I got to throw in here, full disclaimer, of all the 5 stocks we're talking about today on this list, Abbott is one that I currently do not own as an individual stock in my portfolio. And number 4 on the list is NextEra Energy. When we're talking about energy stocks, it kind of goes without saying that good companies like NextEra somewhat have a good immune system when we're talking about recessions, dips, and overall inflation and how it pertains to the stock market. When you look at it as a more of a relative example, cutting back on power and energy usage for residents or business owners is not the same as cutting trips to the movies or going on vacation. It's easier to save money, but most people still have to have some type of power or energy source during economic downturns. And unless you're a volatile utilities company like PG&E, which is based out of California, that have seen some major lawsuits and major liability issues, companies like NextEra Energy or even Duke Energy or Valero Energy typically have that good immune system when we're talking about economic downturns, and their stock typically isn't as volatile and it's more stable, which is something investors like to hedge their bets against during recessions and dips. NextEra is trading at roughly $77 per share and has experienced an increase of over 350% the past 10 years. Their dividend yield is roughly 2.18%, which comes to 42 cents per share. And fifth and last on the list is Home Depot. Almost identical to Lowe's companies, Home Depot experienced such a massive boom in sales and revenue when 2020 hit and everybody was stuck at home, because home renovations, like we mentioned before, were literally through the roof. Now, when we compared them to Lowe's, although they haven't been as dominant Lowe's, they still have seen a decent increase. And over the past 10 years, they went up over 441%, which or equals to 41% each year on average. Now, let's just pause for a minute right there. Even though we say it's not, I'm saying it's not as good as Lowe's as far as the increase, having a stock that averages a 41% increase year over year on average for the past 10 years is simply amazing, because historically, since the 1920s, the S&P 500 index has roughly increased anywhere from 9 to 10%. So having an individual stock, what we'll talk about in a minute, that also pays out a dividend is just an incredible, stable, but yet increasing blue chip, blue collar company that is going to give your portfolio some good growth. When you look at Home Depot's dividend yield, right now it is the highest yield percentage of all 5 of these stocks, which right now is at 2.69%, which equals to $1.90 per share. The truth is, even if these stocks or these stable stocks drop another 20 to 30% right now because of recession, the ability to have the chance to purchase a stock, any of these 5, or really any total ETF or mutual fund, the opportunity doesn't come around very often. We saw from 2008, it was all the way to 2020 before we saw a major drop in stock prices. And then now we're seeing one in 2022, which, could it go into 23? We don't know. But having the ability to buy some of these stocks at such a discount is such a great opportunity. So if you're looking at buying more stocks during this recession, go check out some financial sites, talk to a certified financial advisor, let them walk you through the ins and outs. And please don't let your drunk uncle tell you which stocks to buy or not to buy because he thinks one individual politician like Trump or Joe Biden can either make or break the stock market. As always, thank you for watching the channel. Don't forget to hit the like button, and we'll see you later.